Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into the economic data and see if we can make any sense of it. Now, I've got a lot to talk about. In fact, it seems like I have a mountain of stuff, charts and graphs and other stuff I want to get into. But first, I want to talk about the trade war and the bond market, because I know there's a lot of people say, hey, I know we're in bonds and whoa, what's going on? Why all of a sudden there's this downward move? What happened? Why did it happen? But more importantly, is it going to reverse? And the answer to the last question is yes, it is. And I'll show you there's plenty of case for why that is going to happen. So what did happen in the bond market? So going into Wednesday market close, looking over the last 5-6 trading days, it really looked like the bond market was bottoming out. There was decent trading volume, bottoms being set in, and it's like, hey, this is good. This is kind of what you want to see. There were several open gaps, and what a gap is, and for those of you that are watching this for the very first time, a gap in a price chart is when the closing price from the night before is higher than the opening price. Because normally what you want to see is the two, close together, or an overlap is even better. And markets make this big move sometimes up or down. And I really can't give you a great explanation for it other than here's how it kind of works. Let's talk about a gap down. So if someone comes home, they're like, oh my God, I own bonds and the bond market's falling. So they go and they click sell. Now, does the market sell when they are home and the market's closed? No. So what happens is they put in a sell order, and it is a market order, meaning at the next available time, i.e. market open, sell. Now what happens if you get a long line of people building up that want to sell, and the market isn't dumb, like, hey, someone's kind of walking, I'm like, I'd like to buy some bonds. Whoa, look at all those sellers. Hey, I think I can get a better price. And so I will set my buy price well below the former closing price from the night before. And so as this flood of sellers comes in, the buyer picks up their order at a lower price, and you get a gap. Now, what's weird about these gaps is like 99% of them get filled. Now, you can go dig deep in charts and be like, man, there was one many, many years ago that hasn't gotten filled yet. But for the most part, these things almost 100% of the time get filled. And why does the market do that? Well, it's like, think of it like surge pricing. And I don't use Uber hardly ever, but I know in certain times that if you're in a hot location, they have surge pricing. So you want to Uber, and so does everybody else. Like you're getting out of, say, a football game, and everybody, hey, I've been drinking. I don't know, I'll pick my car up tomorrow. I want an Uber. Well, the price goes up a bunch in order to see who really wants to pay. Now, the next day at that same time, when there's no football game being let out, what is pricing models? Well, it's back to normal. And the same kind of thing works with price gaps on these charts is the market wants to go make sure that it found all the other people that may not have had a chance to buy or sell there. And so what you get this phrase called filling the gaps. And the more gaps you see on a price chart, the more likely it's going to get filled. In this case, in the bond market, there's a bunch of them. I mean, too many. So we know that bond prices are going higher. But nevertheless, what happened would have been Thursday morning around 2 a.m. China put out a news article. Now, I see this on Twitter, so we'll just go with the fact that they tweeted it, but I'm relatively sure if I dug a few steps below, there was actually, something in the China state media that essentially said, we will not agree to any trade deal unless or if the key word was if there is a rollback in the tariffs that both sides effectively mutually agree on. So the bottom line was, we'll agree to a deal, but the U.S. and China will need to both together roll back their tariffs. Now, the computer algorithms that trade this market They trade the cash markets, which is what you and I would perceive during market open, but they also trade futures markets, which are not open 24 hours a day, but they're open a lot. Not on weekends, but during the week, they're open frequently. Now, the computer algorithms don't speak Chinese. They're US made by Russian programmers mostly, but that's beside the point. So they use translation software. You see where this is going? The translated version got misread by the computer algorithms and said that the US and China had reached an agreement to roll back the tariffs for the phase 1 trade agreement. If you read that way, what would you assume? There's a trade deal. It's done. And so these computer algorithms traded on the fact that they thought the trade deal was over. Now, these computer algorithms do not have opinions of their own. What they do is they scour the markets, Twitter, Google. They search through all the stuff that's being, content that's being created, and they try to get a general view of what the consensus opinion is. So when you have a consensus opinion that the conclusion of the trade war, and I don't know why this is, but just as what the consensus is that stocks will go up and treasury yields will go up because this is going to be very inflationary. Now, between you and me, phase 1 of the trade deal is a farm package for the most part that puts China buying the same commodities they were buying like 3 or 4 years ago. That's not inflationary at all. Maybe in the farming sector, but not, it's not going to drive Apple stock up. It's not like these farmers are running like iPhone 6s going like, man, I can't wait till China comes and buys some soybeans so I can get one of them new iPhones with the 3 cameras on the back. They're not doing that. But that's what the market thinks. It's just general public thinks because that's what the financial media has told everyone. So these computer algorithms around 2 a.m. jammed U.S. equity futures higher because, remind you, trading volumes are about micro thin during these times of the night because foreign people aren't trading U.S. equity futures a lot. And so when you have a big buyer come in and there's nobody selling, boom, you get a pop in price. So they jammed the stock prices up and they slammed bond prices down or yields higher. Now, when I woke up, I was obviously a bit surprised to see the change in price. And I was like, man, what happened overnight with treasury yields because it doesn't make any sense. And when I went on Twitter, here I found all these people saying, oh, look, there's allegedly a trade deal. I'm like, that's shocking because wouldn't President Trump be tweeting this? Yeah, he would. Well, anyways, after a few scrolls down the Twitter feed, there was a lot of people saying, oh, look, here's the original post in Chinese, here's the translated post, and here's literally the word. Instead of if, it reported as is, and they got it wrong. And so China said, look, we're not going to actually sign anything unless the tariffs get rolled back. Think of it like a nuclear war, right? You've got nukes, I've got nukes, you've got 5, I've got 5. It's all right. Well, you're going to destroy them, but I'm going to destroy them. We're going to watch each other. All right, well, okay, boom. Now we got 4. They want to see this roll back just like it's, an arms race. That's what China wants. Now, I knew there was no way President Trump was going to agree to anything like this because it would politically be very suicidal going into election in the next 12 months because I would, and I'm sure I'm not the smartest guy in the world, I'm sure the press would say, and his onus would say, why did we spend the last 18 some odd months dragging our farmers into the dirt only to just immediately roll back the tariffs on nothing? Right? Why would that happen? It doesn't seem like it was something he would do. In fact, it's something he said he wouldn't do. So Thursday, the market's reacting, trade deal's done, boom, 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 boom. And I'm thinking, what? These people are insane. There's no trade deal. Friday, and then you get things like unnamed White House source. Well, you know what? Unnamed White House source, it's made up. Fake news. So then Friday morning, today, Navarro, who is essentially the head dude in charge of foreign trade, or national trade director, or whatever his official title is, comes down on Fox News and says, there's no rollback of any tariffs coming. In fact, the only deal that we might agree to is to not put in place the December 15 tariffs. And I'm like, that's exactly it's what I thought. And then President Trump comes out shortly after markets open and says, I didn't agree to no, there's no rollback in tariffs on this deal, because he has previously said we need the tariffs to enforce the trade deal, because if he takes them off, look, this is all we're asking China to do is do something. And he's right. We need to have an enforcement mechanism if we're going to do it. Well, what's the enforcement mechanism? It's the tariffs. Now, I'm not saying, I agree with any of this or not. I'm just saying I get what he's trying to do. And you've got to have an enforcement mechanism, because if you think China's going to do what we asked them to do, you're crazy. So he reiterated, no tariffs are coming off. The only way there'll be a rollback is he mentions like phase 2 or 3, or I don't know if the news added that, but anyways, the media added it. But anyways, he said, look, down the road, there essentially is going to be, checkpoints. You meet to this criteria, then we'll roll it off. You make that one, we'll roll it off. Okay, I get it. That's what he wants to do. Within an hour, the China state media reported and said, if there's no rollback in tariffs, no phase 1 trade deal ain't going to happen. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Material is not to be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So the question probably asking is, well, why didn't these algos reverse themselves? Well, one of the problems with these algos, well, let me finish what happened with it. So these trading algorithms, jams stock prices up, bond prices down. Now, a few days before, one of the guys that talks about his quantitative computer models at the company he works for, and he's one of many, said, look, based on where interest rates are going, these models are going to go from buying bonds to shorting the bond market. And that flip occurs Thursday, because now all of a sudden these other algos, who nobody knows what they do or why they're doing it, drove the interest rates down, bond prices down, and then these quant models came in and sold. So what you had was computer model selling on fake news. So what do you do when you know what's going on? When you know, okay, look, there's been selling by computer models that don't have any emotional attachment. One of them is just trying to read sentiment and trade accordingly. The other ones are trading literally on formulas. If these things happen, sell. If these things happen, buy. That's all they do. They're formulaic based, and they do it during the day. So what do? Do you sell? No, because you know the news is fake. But we also know that the way these algos work is they're not like, all right, jam it up one day, and then, oh, I'm wrong. No, they're kind of like that person, ready, set, and then they take off running, right? There's no one said go. There's people lined up to race, and for some reason they run out of the gate early, and they're running down, and they kind of are looking back going like, I'll just pretend that I'm right. And that's the way these computer algorithms work. They'll trade a position, and they'll hold it for a few days to see if they can get people to, because if all the other runners start running, then the race is on. So they try to just see if everyone will run with them, and then when they're convinced otherwise, if the market starts to move against them, then they'll start selling. So is this really a surprise today that the computer algorithms didn't completely reverse? No, it's not a surprise to me at all. But that's what happens. So as an investor, when you know the market's moving on false news, or fake news in this case, and it's being done by computer programs, well, guess what? These computer programs can be pushed quickly in the opposite direction, because those quant models that sold based on a trigger, guess where that trigger to buy back is? It's not that much higher. And if you see those quant models start to come back in, what do you think these other machines are going to do? They're going to come back in because they're short the treasury market. And next week, I'm going to put together a really interesting piece about shorting the treasury bond market. I guarantee you've never heard. So let's get into the charts. So that's what the deal is. You shouldn't really worry about it. I mean, it's not fun. I'm not saying I enjoy looking at the price charts given the positions, but I'm just saying, the market's going to reverse. So let's take a look at the money supply. The growth rate was up slightly to 6.88. The 6-month rate of change is showing 4.5. This is showing this going to 9%. That seems hot. The 3-month rate of change is effectively validating that the money supply is going to get up to. And you know what? This is the old chart. No, this is the wrong chart. I was looking at my charts and I copied the wrong chart in the wrong spot. Well, There it is. So anyways, this is commercial industrial loan chart. So anyways, you're looking at the wrong chart, but the data is right. And it's saying the money supply is going to get higher and higher. It seems unlikely because commercial industrial lending and whatnot is not doing that well. So let's take a look at real estate loans. Growth, since I can't get the charts right, growth rate is up to 3.58. Even though this is pre-recorded, it is recorded live. And I think it's more fun that I do it that way. So there's no editing, no going back. We'll just have to work with it. Growth rate was up to 3.58% from a year ago. We're talking a couple hundredths of percent there. But notably, the 6-month rate of change is sitting around, it's been hovering at 1.73 for a couple months. So I'm just going to say it's flat. It's just oscillating slightly. And if you double this, you effectively validate the 3.58 number. And the 3-month rate of change is saying, quadruple that. It's roughly around 4. And over, the last year plus, it's really gone nowhere. You can really see going back here into 2017, the real estate market is holding flat right around this 3.5% level. And we're seeing mortgage rates tick higher. We're in the short term, we're seeing this go up. And that's going to be partially because people lock in their mortgage. I'm sure if anyone here's gotten a mortgage, you've done a rate lock at some point. The mortgage rep calls you and says, hey, rates are low. You should lock it in for the next 30 days until you close. And so there's no surprise this is ticking up a little bit. But anyone who thinks refis are going to get better as this rises, not likely. So the real estate market is really not generating a lot of money into the economy. And here's the commercial industrial loan chart. This is last week's chart, but there really isn't much change. The growth rate just fell slightly, a couple hundredths of percent down to 4.48%. 6-month rate of change has been oscillating, plus or minus 0.22%. So it's rising off its negative number at 0.22. Well, you double this and you're at 0.5%. So you can see the long-term 12-month growth rate is way high. And the 3-month rate of change is suggesting both of these are going negative. This is rising again slightly, 0.1% higher from last week. Now, when I blend the two together, and I didn't put it on here, the 3-month rate of change is running a little over 0.3%. So it's showing that the economy is not making money. And this is really important because when you ask yourself, hey, if I own bonds at my misposition, how do they work? Why do we have them? In a post 1971 world, when we went up to gold standard, interest rates, think of them like a sponge, right? My washer leaked the other night and I fixed it before and I'm like, great, I know exactly what this is. I can fix it. And I think it just was a little overloaded and had some water came out, but I knew how to take it apart. I knew where it was probably leaking, the drain. And I pulled the drain out just to see if maybe something that was not in the drain tube was jammed up and water spilled out. Duh, where do you think it's going to be, right, Steve? I should have been prepared for that. But nevertheless, that's because last time I fixed it, the water was already out from the hole in the drain tube. So anyways, but think of it like a sponge or a towel, right? I immediately then, reached into the drawer. I have some old towels and started soaking up the water. That is what interest rates do in a fiat currency world where you don't have a gold standard, where literally the currency is out there floating around. So if you see an increase in lending demand, what you should see is a corresponding increase in interest rates to start to soak up those dollars. So when you look at this and you say, is the bond market misreacting? And the answer is when you have the two biggest money generators, one contracting on a 3-month basis and one barely growing, and the two combined growing at 0.3 something on a 3-month basis, the answer is no, you're not getting reflation. So looking at credit card growth rate, flat at 4.54 over the last 2 months, and we'll probably talk about this in one of my mini slides. We've got to go. Consumers are paying down their credit card debt. So again, you have more evidence that no, there isn't a lot of growth. In fact, in the loan data that came out for September, market was expecting U.S. consumers increase their lending by like $15 billion, and it was only around $9 billion because they paid off their credit cards in August and September. People are paying down their credit cards. Not something you see in a reflation event. Not something you see at all. All right, let's hit the other stuff. Might go a little long. I don't know, just because we're not going to have a chart. We're not going to have a video on Monday. There's no reason to. Looking at the H.8 report, and this would be for the week before, just a slight decrease in bond holdings by the banks, $3 billion. This isn't enough to make a major move in the market at all. So you see they dropped their mortgage-backed securities by about $4 billion, even though they should be picking up more of them this next week because of the Fed's. We can start rolling. They got to roll off $20 billion a month of mortgage bonds, so the bank should be picking some of these up pretty soon. So usually they buy the $20 billion and then they try to sell off a couple billion of them. No big deal. Looking at Treasury and agency securities, no change, none. So people looking at the bond market and saying, "Oh, it's a big bank selling." Nope, big bank. They increased by $500 million. Looking at other securities, they increased their non-government insured mortgage-backed securities slightly and increased their non-government bonds slightly. So again, no major selling here by the big banks to suggest that the bond market is toast. Now, I haven't seen any reports on what this is going to do to ag commodities, but apparently it's going to be super cold from most of Texas through the growing region here, and there are farmers that are still harvesting. I don't know if this is going to bring snow. Now, during the day, we see precipitation is going to be below normal, but doesn't mean that's going to be bad. I know they've gotten too much rain in some areas, and tractors are getting stuck in the mud, and looking out the next 8 to 14 days is still going to be cold. The question is as they're harvesting, what problems this cause, and maybe does a ground freeze where they can't get the winter wheat in? I don't know. Because the USDA keeps not wanting to accurately report what the farmers are saying. No surprise that liquidity conditions are moving a little bit higher as the market moves up. Well below where liquidity conditions should be. So we do know liquidity remains tight and can reverse at any point. But equity investors seem undeterred by any new. You tell them there's no trade deal and they still buy stocks. All right, let's talk about something near and dear to my heart, which is the Fed's monetary easing working? Because if you own bonds, there's a lot of things you got to look at. There's a reason now. I made the mistake in 2016. I own up to it. I was wrong. That's why I look at the weekly mortgage data. We look at all this lending data. And there's one question I keep asking every day. Am I wrong? Am I wrong? Am I wrong? Am I wrong? Am I wrong this time? And the answer is always in the lending data, because if you understand in a fiat currency that lending growth leads to higher interest rates, then you need to know where to look. And if you see higher interest rates and declining lending demand, guess what? The interest rates are going to come back down, because higher interest rates and weak demand means that there's going to be even less demand. So at the moment, we look here at the monetary base, and we can see quantitative 1, 2, and 3. And this is what we're interested in, because the reason I'm pointing this slide out, and I probably will do it in many weeks to come, is I want you to see the effects of the Fed's easing, okay? These big sharp moves higher. So the question we want to know as investors here, is the Fed's easing working? Because if it is, then we're potentially mispositioned. If it's not working, then the market's mispositioned, okay? Very, very important to understand. So let's go back. And I thought I had it zoomed in, but apparently I did not. So let's go and fix this. Again, we are always pre-recorded, but as you can see, totally live. All right, so let's zoom in. And here you can see this last week now in October. So here to here, it's really somewhere down in here, but here to here, what did the Fed do? You got a 0.25% rate cut, which is effectively like adding $60 billion into the economy. You had over $200 billion of various overnight and term repo loans or dollar loans. So that's money injected into the economy. And you had $60 billion of not quantitative easing where they bought $60 billion worth of short-term treasury bills. Now, you'll notice it is pretty much only gone up. Here it was 3.286, 3.294. It's increased $8 billion, or from October to here, in the month of October, you had over $300 billion of easing, and you had a $4 billion increase in the monetary base. You say, well, I don't know if I buy that. Okay. Let me show you what. Here, look at the difference. Boom, boom, boom. Look at these big jumps. That's what we should be seeing. That's how we know reflation is going to happen. No reflation. And when you look at it, because we don't have the quarterly data on the foreign held treasuries, we have the monthly data, but unfortunately don't have quarterly. If we go to the year-over-year percentage change, which gives us our closest proxy for world dollar liquidity, what we can see is world dollar liquidity, I think it's going to be higher, but it's still in a contraction. So what that's telling us right here is not only the Fed policy is not reflationary and the market thinks they're reflationary, but we're still destroying dollars. So that means the global economic data should continue to get worse. Not better, worse. Again, always check. You know, so many people buy an investment and don't look, they just think, well, it's going to go up or whatever. I assume they don't buy a thing that's going to go down. But when you are investing, you always need to ask, keep checking it. Am I right? Am I wrong? What does the data say? Because you can be wrong and the data is right, and ultimately the data will come through. You can be mispositioned. The market thinks one thing, but the data says the other. The market will come to the data. Always. Never goes the other way. All right, so let's keep moving on and keep asking questions. Are we wrong? This is lagged data, but it's what it is. This is total consumer credit owned and securitized. And I underlined the 10-year Treasury security. So you can see this is very volatile. It, generally up 1 month, down the other. But this is essentially this whole last cycle. And what this is showing is on a year-over-year basis, over here on the left, what consumer credit owned, how much it's growing by. And just so you can see, during recessions, it starts to roll down. And then this is where people are paying off debt, defaulting on debt, not taking out new debt. All right, just so you can see. So you can see the cycle came out of the negatives. And if we could smooth it, then there's no way to do it using the Fed's built-in machine or system here. But nevertheless, you get the idea. But last 2 months, let's see if I can stop on it. August, it fell to a 5.19, and then it fell to big drop to 2.76. Now, what was the big drop to 2.76? People are paying off credit cards. So the only lending growth is in autos and in student loans. But at 2.76, you're right near these bottoms that have existed through 2017. The next closest one, you got to go all the way back to 2011. So what it's saying is consumer demand lagged, is telling us there's not a lot of borrowing going on here. There's an interest to pay off debt. So again, rising interest rates here are not going to encourage people to go out and borrow. I mean, I can't imagine there's people out there going like, man, I just can't wait till interest rates go up so I can go get a loan and pay more. But I want to point out that with the 10-year Treasury bottomed, is also at the same point, there was the least amount of credit growth this year. This year, there it is. Not by much, but this year. Now you would think, right? Look at that low interest rates are inflationary. You keep hearing that. No, they're disinflationary. And so you can see lending demand is falling, interest rates are falling. So again, no sign of reflation here. So if you think that people aren't going to borrow when interest rates, now probably next month we'll see an increase because of low interest rates. But nevertheless, if you're not getting people taking out more loans as this drops, what do you think this is going to do? Encourage people to go borrow? Not likely. Let's go look at the SLOOS, or the Senior Loan Officer Survey. I said this is going to go long, but I got a lot, and I really want you to see that I've looked at, I'm turning over every rock here to make sure that what I'm telling you is true. This is the Senior Loan Officer Survey, where the Fed interviews senior loan officers to get opinion on what's going on in terms of supply and demand for loans. So we'll go through all these. Here's demand for commercial industrial loans by size of firm. Now, it goes back to 1990. And there's a lot of this, so I'm going to scroll down. There we go. And hopefully you can see this. And so it says net percentage of domestic respondents, banks, tightening standards for loans. Now, when a bank tightens standards for loans, does that mean they want to loan more money? No. What it means is real simple. I've got 3 borrowers lined up. Good credit, pretty good credit, bad credit. I don't want the bad credit. You go away. I'm cherry picking, okay? So when you see a lot of lending growth, that means banks taking, hey, you got no credit at all? How much money do you want? Come on in, sir. Have a seat. And you got some friends with no credit or bad credit? I'll give them money too. Call them up. Now, that's when you see, boom, big expansions in credit. When the banks are getting picky, and I'll show you, look at this. You can see, not picky, not tightening, and all of a sudden tightening, not tightening, boom, tightening. Small banks, tightening. Net percentage of domestic response increasing spreads and loan rates, forget that. Here, net percentage of response banks reporting stronger demand for loans, minus 20. So 21% of banks that respond to the survey says they're seeing less demand for commercial industrial loans. No kidding, right? We just looked at that. Small banks, net decrease. So you have tighter standards, less demand. What do you think is going to happen with interest rates? Are they going to go up? Not into that. Now let's look at commercial real estate loans. And these do change a little bit. So tightening standards for commercial and land development. You see this has been increasing. 16% report their increased tightening. Non-farm residential, 10% tightening. Multifamily, 12% tightening. These are demand for construction land development. That's falling. Non-farm residential, flat. Multifamily, lower. Not what you really think should happen. Next one's going to be residential. So again, if you see higher interest, you want to see these things going higher. So let's look at, what do we got here? Tightening standards for mortgage loans, subprime tightening. But here's what I really care about on this one is you do see decent demand for government-backed loans, jumbo loans, and you see you've seen lack of demand here as when interest rates were higher, but as they've come down now, all of a sudden there's some increase. But that increase is not translating into a big demand of loans, as we've already looked at. So measure of supply and demand for consumer loans. So far that you can take away from this, only the real estate market is seeing increased demand. But when we look at the weekly data, it's not showing the demand is or demand is enough to drive the amount of loans higher. So net percentage of response tightening standards on consumer loans. So credit cards tightening standards, 10% and say they are, 6% on loans excluding credit cards and autos, and net percentage of respondents reporting willingness to make loans. Not many. So you're seeing banks are not excited about making a lot of loans all of a sudden to consumers. So let's look at supply and demand for consumer loans. And I bet this is up. So let's see, credit card demand is increasing. Autos are increasing. So consumers are wanting to borrow, and excluding credit cards and auto, mild increase. So there's some demand here, but banks are saying, we're not convinced. We don't want that. So again, you kind of get the idea. There isn't a lot of demand for higher interest rates here. So the market is trying to jam interest rates higher, and there's no demand. That means they don't stick. Let's look at this Wyckoff price cycle again, just to confirm again what we see in the price charts. We see accumulation periods get marked up. Then there's a second accumulation period before it gets into a distribution. And notice that accumulation and distribution areas are long periods. They're not short. They should be equivalent to size. Now, one thing we've been looking at is this chart here. We've seen this oscillated pattern here. And what you see is a long accumulation, a ramp up, a consolidation period, and then the final move out. So let's go and look at the price charts. And here we are on TLT. And let's zoom out. Now, what do we see here? Well, we started to see this sideways accumulation move, and then we saw this dip here. And that obviously has some people worried. Are we wrong? Well, part of it is fake news. So let's go and look at here. Flags and pennants. So this is what I was hoping we were going to see. This big move higher. This is the flagpole. And then you get a pennant. I don't know if some of you are old enough to remember when colleges, I don't know if they still have those little pennants you would hang on the wall. I had some when I was a kid from various relatives that went away to school. And I guess it's what you bought and gave to people. But you see this oscillating pattern, this breakout higher. Well, sometimes you get a bull flag, which is also a Wyckoff accumulation pattern. And the way you measure this is from the bottom of the flagpole to the top of the flagpole. Wherever this stops is where it goes. Now, you see here 1, 2, 3. There's not always 1, 2, 3, but that's just how these things are drawn. And I think he shows, here you can kind of see, here's the flagpole, here's the bull flag, and then it takes off. So you measure from here to here, and you get that move from here to there. So let's go back to the charts. and see what's going on. So do we have a flagpole? We do. We have a flagpole from here to here. Maybe from here to here. I don't know. I believe we're going to count. I believe it would be properly counted from here to here. I'm not a super expert on chart. And then you see, let me draw some channels. Again, this is not, there are some people that are super specific about, they have to look an exact way. If they're slightly deviated in any form, it's negated. But here's the picture of that, and we'll just nix off some of these so you can, and we'll make it, too much time. Okay, so you see we're forming what's called a bull flag. And you can see this volume up move here, and what's going on here? The big players are trying to shake out all the people they can, get them to sell so they can accumulate to make that last move higher. Because what a bull flag implies is you have roughly between 132 and 149. So that would be a 37 or a $17. Is that right? 132. Yep. So 8. And then, $17 price change. And wherever this thing stops in here, you would add $17 to that. And it roughly puts this whole thing, depending on where this all is. Again, you could be measuring this from down here. I don't know where the exact measurement of this is. But it's still putting my price target for the top of this thing somewhere around $165, $175 per share, which is a big move. Now you say, well, what makes you think that's so true? Well, when you start to zoom out, you see here's a 3-year accumulation pattern. So if you look at the flagpole from down here, you go from 122 to 148. Now, is that possible? That's your 26. And you tack on 26, and you're right now talking about where I believe this thing is going. Now, you can go back over here and say, well, why isn't this the same? Glad you asked. Small accumulation, small top. Let's keep going. Small accumulation, small top. Notice how it came down, and then it has this tight range in here where people are, this is where the selling's getting out, right in here and right into there. Do you see that here? Nope. Let's go back a little further. You can argue that this was a very long accumulation with a blow-off move here. Look at volume, flagpole up. Here's the pennant. Again, not exactly drawn perfectly. And then here's the final move higher off the pennant. And here's your selling part right in here. So the question I'll ask you is, do you think the smart money spent 3 years buying bonds to make a 3% return? Because I did the math on what they would have made from here to here over a 3-year period, make 3%. The answer is no. Not when you look at the lending data. That doesn't make any sense at all. Now, not to mention, you've got no less than 6 price gaps. You have one. I think that one got filled. Let's see. Did it? Oh shoot, that's even worse. Anyways, you got 1, 2, 3, 4. Yeah, that didn't get. There's 6 gaps. 1, 2, 3, 4, 5, 6 gaps that need to be filled. If it was just one up here, I might agree with you and say, well, that could be like this gap up here that took 3.5 years to get filled, or this gap here that took, a year, over a year and a half to fill with 6 gaps? No way. This thing will come back up at least probably right into here before we know. And if this pattern is right, and it is a bull flag, it's telling us there's an explosive amount of upside in bonds. And the way you can validate that is simply by looking at the underlying economic data. And so when you realize the whole bond move was based on false news based on the trade war, which you have to assume now is not going to happen because there is not going to be a rollback in tariffs. So you can forget all the news. There's no official meeting between President Trump and Xi for the rest of this year was confirmed by President Trump today. It doesn't mean there can't be, but the bottom line is China's saying no rollback. This is Walmart, no rollback, no deal. So the deal's off. That means the market's mispositioned. And when you know that yields and I meant to show you that when yields and bond prices are closely related right now, and the reason that's happening is because the stock market is around out of buyers. So here you go. Let's zoom into the 90-day chart, and you can see, I'll hold my mouse on this, but because of the overnight trading is gapping, you see all those gaps, you can see the two are very closely related. Now, why am I saying the market's running out of buyers? Real simple. Go over here to the largest S&P 500 spider, zoom out a little bit. See this week trading volume? Week trading volume, peak. Week trading volume, peak. Week trading volume, market's trying to go higher. So what's really happening? The equity investors are shorting the bond market to try to flush out the bond buyers. Who are the biggest buyers of bonds right now? Commercial banks, foreign central banks, and even the Fed's buying bonds. You say, wait a minute, I thought the Fed was buying bills. The Fed's rolling off $20 billion a month in mortgage-backed securities and buying equal duration treasury securities. So let's say they sell off a 20-year mortgage. They have to blend a 10 and 30-year bond to get the same duration. The Fed's buying. So with the market close on Monday, I'll see you on Wednesday. And hang tight on the bond thing. A lot of gaps will get filled. Data's on our side. I'm Steven Van Metre. Happy Veterans Day. For all those watching that are veterans, appreciate your service. As always, until Wednesday. Bye now.